Good morning. Welcome to Learning Lending Live. My name is Mike Officer. I'm the founder and CEO of Score Experts Credit Consulting. Today's host, welcome to the show. Welcome back, everybody. The topic of credit is extremely important when it comes to financing and the world of lending. This is where we come in as a resource. Our primary objective is to educate people on credit, how to optimize it, how to build it so that your credit profile aligns with what a lender wants to approve. And then not only getting better approvals, but getting approved at better interest rates so that you can save money and accomplish your financial goals. This comes as a dual-pronged approach. A lot of times people have negative items they need to delete. Other times they have a need to build positive credit history, and we consult our clients on both areas so that they can accomplish their financial goals. We bring you news segments every day so that you can stay on top of changes in the financial industry, especially when it comes to lending and financing. Things are changing every day, and we want to bring those points to you so you can stay on top of those changes as well. Ruben, welcome to the show.
Mike, the credit officer. Thank you so much for hosting today. It's we're really getting going with this Learning Lending Live show, and credit's foundational. So really appreciate you hosting and being the guy to really get this live production going. So I'm not going to be here to bother you too much. I just want to introduce myself. As part of Lifeline AI, we're the creators of this live production, and we bring together educators like Mike to put them in front of investors, and we also engineer everything that happens on this production with the purpose of educating, inspiring, and empowering community business people, real estate folks. And we just do this by collaborating, collaborating, and creating all this content together. Mike, we're really just getting started here, and I feel like we hit it off when we networked together, and had some clients that I was dealing with, and I'm just glad that I was able to refer them to you right away. But hopefully, with the help of anyone who might be watching, we were really trying to find other professionals who can join us. Some of the people that we are looking for, just listed here, is commercial real estate or lending experts, 1031 folks, title representative, escrow representatives, attorneys, financial planners, CPAs, and people who get into taxes, even really just touch a lot of the things that lending requires. So Mike, how is it feeling like? So now this is like your second show. How are you feeling? How you getting? It's like riding a bike, right?
Yeah, I'm feeling good. And I think you touched on a couple of important points. We have an open invitation to other professionals who could benefit from this show, not only as content, but as a resource and as a networking opportunity. Networking is extremely important, and it's important to build trust and accountability with your referral partners. And this platform is an opportunity to do that.
Awesome. Well, hey, so I'm going to let you have at it. I know that we have a lot of things to go over. It's got a lot of great content, but let's get it rolling, Mike. Let's start with the news.
Absolutely. So again, we bring you content each week to inform our audience on changes in the financial industry. Today, we're talking about a couple of myths in the lending industry. The number one being that the 20% down payment myth. And this is that many aspiring homeowners believe they need 20% down to buy a home. And it's simply not true. Different lenders have a lot of different products. There's going to be loan products for each borrower, and you don't really know where you're going to fit into that spectrum until you talk to a loan officer and find out what your options are. Also, segueing into the topic of credit, improving your credit score and strengthening your credit profile can be a great way to open up the availability of other products. So that's one item we're going to talk about. The other is that financing is still the primary way that people are buying homes. Yes, there are cash deals out there. There's investors buying properties in cash, but that's not how most people are doing it. Most people are still your traditional first-time homeowner, or maybe they're buying their second property and upgrading to a larger space. People are still using financing, and financing is going to be the most important and most significant way that people can purchase a home. And the final point is building a down payment takes a strategy. So again, this is where it comes to first focusing on making a plan, making sure your credit is in strong standing, and then being in contact with a loan officer who can help you develop that plan and build towards your loan approval. So without further ado, I'd like to introduce our guest today, Harry Dennis with C2 Financial. He is a mortgage guru. We have worked together for years now, and I have to say, he's the man. He's awesome. You need a lender and you need a loan officer who's in your corner, who's going to help you build that plan and who's going to be a resource to you throughout that process. And one that also has loan products available that can fit your unique situation. So Harry, welcome to the show.
Mike, thank you for the warm introduction. I appreciate you. Again, my name is Harry Dennis. I'm an independent mortgage broker with C2 Financial. And kind of as Mike said, I want to start really at the top. Credit is number one. Starting at a young age, I have 3 children. I educate them on how important credit is, not just for home financing. It's for your insurances and everything now. It's about credit, and really is to understand and educate with experts like Michael and other peers of understanding how that credit works. Today, we're talking about the 20% myth of down payment. Most of the time, these articles that you see out there that are published, that are in the media, it's qualifying with people putting down 20%. And that sometimes you really have to look at the detail of the article. Is it national or is it local? As we're local here in Southern California, our average home, let's say, is 900,000 or so, and 20% is 180,000. And really, how many people have, especially the first-time home buyer category, has 180,000 plus closing, and they want to get furniture to do that. So there's a lot of different financing aspects of that. Mike, you want to say a couple words about that, and then I can expand on that a little more, maybe get a little more detail?
Absolutely. So I think this is where it comes to education for most people about how their credit profile is structured and what are the different factors that go into creating a strong profile and creating one that's going to get approved for a mortgage. And a lot of people just think if they make their payments on time, that that's going to be enough. And it very simply is not. They need to take into consideration their DTI, their debt to income ratio. They need to consider how high of balances they're carrying on their unsecured credit cards. This is a really significant factor. They not only need to do that, but they need to assess, have they opened new credit accounts recently? Have they had a bunch of hard inquiries? There's a pie chart of different factors that make up a complete credit profile, and we need to focus on optimizing each one of them. And this goes back to what I said earlier about having a plan, having a long-term plan, getting in touch with Harry so that we can identify what boxes do we need to check over the coming 3 to 6 months, maybe a year, whatever your plan is, so that we can progress towards having everything lining up where it needs to. And that's where then you can start getting into the down payment conversation. What do we really need to put down? How much do we need to save up? How much do we put towards our credit card balances versus how much do we save for a down payment? And you can strategize all of those pieces.
Mike, so let's kind of start at the top. And one of the most important components of a loan is credit. I have a son turning 18 years old. Let's say he has no credit. How would he get started? But he could be 18 or a younger person just getting out of college or so, and they don't have credit yet. Because I guess in our country, no credit is kind of considered bad credit, so we need to have credit. But go ahead and expand on that a little bit too as well. Again, we're starting at the top with the components of a loan as credit.
You're absolutely right. There is that saying that no credit is as bad credit, sometimes even worse. Lenders want to see a report card of your credit worthiness. They want to see a history that you make your payments on time and that you are a borrower that they can give money to with a low risk. If you don't have a credit history, there's no information for them to make that decision on. And banks are always going to err on the side of conservativeness, right? They're going to decline you if they don't have a way to make a decision. The short answer to this is there are many strategies to build credit quickly. The gem that I advise to most people, which is the quickest, the easiest, and it's also free, is if you have a family member that has really good credit and has a bunch of credit cards they've been around for a long time, the accounts are old, they have perfect payment history, and they've got really nice high credit limits, have them add you as an authorized user onto those accounts. Those are in the next 30 days, those accounts are going to report to your credit. You're going to start getting the accumulated payment history that are associated with those accounts. That's a great way to get you a little quick jump into building credit history. From there, there's a number of strategies that we can employ. That's another conversation in itself, but there are ways to build credit history relatively quickly.
No, that's great information too, and kind of telling the audience to starting at the top with credit, because some people do not have. There's something called the trade lines. They are the credit lines. And from qualifying, we want to see 2, 3, 4 good credit lines. So definitely, if you can be an authorized, being added to a family member's credit card, you're getting their payment history too as well. And then that FICO, the credit score is going to go high 700s, and that is considered excellent credit from a lending standpoint with the best terms possible when you're in the high 700 FICOs. And then that's going to open up a lot of the programs. And really the point today and that article is what other programs are out there besides putting down 20%, because most of us probably are not going to have that. So we have loans. There's a lot of programs out there, from down payment assistance to grants, many numbers based on where you live, your zip code, or the property you're buying, the zip code, and the median income as well. So there's everybody's situation could be a little bit different. So it's just putting those facts together. It's kind of like a puzzle, is putting everything together and see what box you fit into, based on the programs that are out there, based on your income, zip code, grants. And then again, it's just being proactive. I say, just because you're ready to buy the home today, like, hey, Mike, I'm ready to go buy the home today, doesn't mean you're going to qualify, right? We got to have a plan, because, or the home might not even be there, because we're in the prime season of purchasing homes here in the spring, going into summer, where people want to be settled for the fall with the kids going back to school or jobs or whatever that may be. But one of the popular programs too is the FHA loan. That is backed by the U.S. government, and that is a minimum of 3.5% down. I really like that loan a lot for first-time home buyers, because, not to get too in depth what Mike said earlier about the debt ratios, it's having a budget. What is your income every month? What is your expenses? And not only the ones on the credit report of like student loans or car loans, or credit cards, it's, what's your utility bill? It's all that. So when I qualify and pre-approve someone, I want to kind of go through everything. Just because you qualify for a higher price home doesn't mean you're comfortable, or, being too aggressive where you're house poor and you don't have any money to go out once a month with your significant other. So it's really having that plan, being proactive, with those. What do you have to add on to that, Mike, you think?
Well, I think that segues into our next talking point, that most people are using financing to purchase a house. And that makes it exceptionally important that you develop this plan and that you know how to leverage your credit and leverage this financing to get the house that you want. And that starts by planning in advance. Like you said, it's not just something that you can just decide, hey, I got enough, my income can support a mortgage, let's go buy a house. It's not that easy, which is why you need trusted professionals in your corner to help guide you along the process.
Yeah, no, absolutely. With that, when I first have the initial consultation with a client, and I always tell the client, I'll go as slow as you want me to, or fast as you want me to, whether it be today, 6 months, 12 months, 24 months, but having some kind of plan that that you can get into, as well. That's really what's important. And I always kind of line it up with the client going, okay, how much are you comfortable affording a month in a monthly payment? That is key on how much we can afford as a family. We're renting now. This is what we can afford now.
Looks like we might be having some technical difficulties while we wait for Harry to come back.
Okay. I think, let's see here.
We got you back, Harry?
Yeah, I'm back. I don't know what happened there. But anyway, those components I look at is in terms of how much can they afford on a monthly basis that's realistic? How much do they have as a down payment? Have you looked at any homes? They probably have looked, maybe they start the process just maybe online. Maybe they did go to an open house. What is that sales price that you're looking at? Okay, that's 800,000. I can afford X amount. I have a down payment of that. It's a puzzle to me. I put the puzzle together. Are we, Mike, even in the ballpark? And then if we're close, we have different lender programs like buy downs and getting lower payments, cash flow, and all those kind of things. Maybe it is getting, the points or getting a lower rate or looking at not only getting in the house today, but also the future of the next year or 2 years out too. And hey, do we want a landscape? Do we want furniture? Because when people buy a home, if they put all their money in the down payment and closing costs, do they have money to go get landscaping and furniture and TVs and washers and dryers? And they're putting that on the credit card, Mike. And what happens there,
Yeah, exactly. Credit card balances go up, credit goes down. And Harry, real quick, we have a question from a viewer. What's the most popular conventional financing loan available for home buyers?
So on the conventional, they are under the Fannie Freddie loans. And again, 85% of loans out there are backed by the U.S. government. What that means is that's the lowest rates. That's what we want to qualify for, is the conventional loans. So we have programs that are 3%, 5%, 10%, and obviously 20%. So again, it's really looking, Mike, at the down payment. How much do you have? How much is the sales price? And how do we make those numbers work with a comfortable payment too, as well? And there's a big thing now with the gift funds. We can take gift funds. I'm seeing a lot of baby boomers that have money that's going to go to their heirs when they pass. They are speeding it up and giving the money now while they're still alive as part of the down payment. Again, there's a lot of different strategies that we can talk about of the down payment, but they want to help their children by getting them into home ownership, especially where we live in Southern California, not only for home stability, but to have the generational, create the long-term wealth by using real estate as an asset and as a tool.
Absolutely. And I was going to ask you about that. There's a strategy to how to formulate the down payment. Where do the funds come from? How is it dispersed? And I know there's a lot of different ways and a lot of different sources that those funds can come from. To share a personal example, when we bought our first house, everything was good. We had enough for a down payment. Everything was in place, but we had a tax bill. And so the lender would not approve the loan until we satisfied that tax bill. So we actually took gift funds from my parents and paid off that tax bill. So in a way, it's one of those ways to strategize. Where does the down payment come from? Where does the different sources of funds come from? So can you elaborate on that a little bit more? What would be other key points of this strategy that people could look to?
Yeah, Mike, what a great question. I mean, and you're so blessed to have parents that have money to help you. I mean, a lot of people don't have that. So, I'm talking to people that don't have again, you're very fortunate to have that. But also too, let's say you went to school and you have a 401k and you've been putting money away, tax deferred, you've been putting that money away. Well, we under that FHA program, we can borrow against that money. I believe you got to check the numbers. I believe up to $50,000, but you can borrow against that money for the down payment too, as well, to help you. So that's just another avenue, because we know we could go through your budget here and we know where we live and, the income coming in, you're paying your taxes, and then you have all your expenses, and then you have health insurance and all that. At the end of the day, how much do you really have left over to save money too? So we have to look at those strategies. And that's where I think if you put the money tax deferred in the 401k and you have that money, we can tap that as one option. There are, again, we can get in more detail in the next conversations, is down payment assistance programs, grants. There's a lot of different things too. And again, if we have to, maybe it's a family member for a gift to help you out. There's seller concessions to help with closing costs. Maybe they can give you $10,000 as a credit towards your taxes and insurance and your closing. So you're just coming up with 3.5% down. So you're saving and saving. And again, it's always good to have the plan and talk early. You might not be ready today, but maybe it's a 2-year plan. If we can set what you have now on a 2-year plan, and you're putting away a couple $100, $500, whatever it may be a month, it's going to add up over time. And that's where you have to look at it. And your antennas, it's kind of like when you're buying a new car, Mike, right? When I buy a new car, how come I see the same car everywhere? Before, I never saw the same car. So it's the same thing as having a plan, put it in writing, sitting down, and let's execute and see that plan together for the next 6 months, 12 months, 2 years.
Mm-hmm. Absolutely. And I think forming the foundation of this plan for a lot of people is becoming more disciplined in your financial habits. That's a really good place to start, right? If you know you have a plan and you know the areas that you need to satisfy in order to get there, then you start by changing your financial habits, spending less money on credit cards, maybe just spending less money in general, so that you can improve your credit, start to save for that down payment. And relating to the clients that I work with in credit repair, many of them are looking at different loan types. I work with a lot of military and veteran clients that are going for a VA loan. A VA loan technically does not have a credit score requirement, but lenders are still looking at your credit profile. They're looking at your credit worthiness and payment history, and they're also looking at your derogatories. Have you had accounts in the past that you didn't pay? And those are all reasons why you still need to focus on strengthening your credit and your credit profile, even if you're going for a VA loan. So the different loan products are going to have different credit score requirements. And this is all something we need to plan in the beginning, talking to myself and talking to Harry.
No, Mike, one of the best things out there is the VA loan. If you're a veteran, the U.S. government rewards you with, you don't have to put any money down. I mean, again, you have to qualify with your income, but that, no money down. And the VA is known as the best rates for financing out there. So really, it's just a magnificent program to help our veterans out. And again, it's just starting and educating them on these VA loans backed by the government with no money down. Competitive rates. There's no mortgage insurance too, as well, because you're putting down, 0 or less than 20%, and the rates are still competitive as someone would be putting down 20%, if not better. So if you fall into that category, and see where your benefits are, and by ordering that certificate of eligibility, those are what a wonderful program too, as well. And they're very lenient, like FHA, with the underwriting and with blemishes in the past of lates and all that kind of stuff. It's a calculation they take into effect. I've helped personally veterans where they have no money in the bank, but they had a retirement plan of $10,000, let's say. We use that money as the earnest money deposit to get them into a house. They made the payments, and in 2 years later, we know our market's very volatile here, they've generated a couple $100,000, in owning that home for 2 to 4 years. By what they were doing is renting. Now they're owning. They use their money for the retirement as the VA, and now they're in the game. Now if they want to do something else, they have hundreds of thousands of dollars in equity to move up or whatever it may be. But again, they have more options now because they got into the game, and we're just educating them with a plan.
Gotcha. Harry, I have a question for you. Let's say you have a client that maybe is in the approval range with their credit, maybe mid to high 600s. How have you seen a further improvement of credit score affect the down payment that borrower has to put down? Is there any changes that occur as the credit score goes up? Are there, what can a borrower expect as they strengthen their credit?
Yeah, I would say there's a couple components to that. Number one is if you're 660 to 680 and you go to, high 700s, mid 700s, your interest rate, number one, is going to be better. So it's going to, that's going to save you hundreds of dollars every month on a cash flow basis because your credit score is in top tier, which is less risk too. Also, certain programs have higher restrictions with points or just added fees, interest rate higher or lower, added fees because you're more of a risk by, with the conventional by putting down 3%. that program could be a lot tighter to qualify, and you might not qualify for the 3%, and then you would be at the 5%. So what I would do is, again, looking at what you have now, take the temperature. Where am I at? Baseline, credit score, and everything. Talking to people like Mike, yourself as a credit expert, so we can get things. A lot of time, it's just the time we run the credits, the middle of the month, and your credit card, okay, I pay my balances down or I pay them off. But the time I ran the credit, you have a $5,000 credit card, high balance, but you charge $4,000 that month for whatever reason. So you could be considered maxed out. So your credit score could have been 660 that month. We pay that off, or we get that balance or that the amount to charge increased. The next month we run it, and you're at 750. So it just depends. But again, it goes back to get the credit score as high as you can. And there's programs out there where you can analyze the credit to do those what if scenarios.
Absolutely. And if I might add too, when you improve your credit score, you really can do the math about how this is an investment. And I think it's super important to have an investment mindset if you don't already. Getting into real estate, obviously people want to own their own home simply because they don't want to pay rent. They don't want to pay somebody else's mortgage. But if we look at the financial building side, the financial long-term plan, you're going to get serious appreciation in that property over time. And you're going to have the opportunity to refinance in the future. Maybe you take out a HELOC, maybe you do a cash out refi to progress in your life towards larger financial goals. So when we're talking about real estate, when we're talking about credit improvement, it's exceptionally important to think about what kind of return are we going to get on this investment. And by making a small investment now into strengthening your credit and getting into the real estate space could yield tens to hundreds of thousands of dollars down the road. So Harry, I wanted to ask you, you have a lot of experience in a real world example. How have you seen a client who's been able to get into the real estate world to purchase a house, and then a couple of years, maybe a few years down the road, did they do a refi? Did they do a HELOC? What kind of actual numbers are we looking at here that somebody might expect, especially here in the Southern California market?
Yeah, it goes back to them having a plan. A lot of times it's getting in the game. They have a starter home, or now they're getting married, let's say, or they're going to have a child. So they want to look and have a plan of like, okay, we're in a condo now, but how do we save money? How do we have a plan to do that move up to get a yard or to get a house too as well? So those are the important things, and adjusting like, okay, how much equity do we have in our house now? What do we have in our savings and retirement plans too as well? How does our credit look? Just to make sure everything is sharp, all the parameters are there. So when they're ready to go, they're in a proactive stance, and they're able to really put a strong, competitive offer for the home they want to as well. So it's just kind of like, it's just analyzing every 6 months, 12 months, like going to the doctor or your financial accountant or CPA, is making sure everything's in line.
And have you seen borrowers, have you had them come back to you and do a refi later on down the road? And if so, like what kind of equity did they have at that point? How much cash out were they able to get?
Yeah, so there's a couple things. So what happens is if we just get them in the home, let's get them in the home. The rates are so volatile. So what I do is like every 6 months, I'm in touch with them. If the rates go down, we look at doing no cost refinances. So all we're doing is just lowering the rate. There's no closing cost to get them the cash flow. Let's say we save them $200 or $300 a month. So that money can be put away for a 529 or for their kids' college or that next home. So it just depends on, again, what are their goals in doing it. If they have debt, I've seen equity, the equity goes up pretty fast here. Again, it's a long-term thing over time, but we can look at, is it cash out? A lot of people don't want to take cash out. Some do, but we use the house as a tool because it's a cash flow thing every month, whatever the rate is. It doesn't matter because we know credit cards are 20 to 30%. But at the end of the day, if we're W-2, let's say, we're only going to get a pay raise of 3 to 5% or what we're in with that percentage. How do we maximize and get the cash flow? I usually give, if we save people 10 to 20%, that's like, net of tax or gross of tax, that's a pay raise. I'm giving them more than a pay raise by reconsolidating their debt using the good debt of the house versus the bad debt of the credit card or student loans to give them that monthly cash flow. So I'm giving people 10 to 20% pay raises if they have the home over time. Credit's good, equity's good, and things are moving forward.
Absolutely. And just to wrap this up with, again, a personal example, and to incentivize people to really make this plan, solidify your financial habits, and be able to purchase a home. With the first house that my wife and I bought, it took us a few years, but we were able to outgrow it and we were able to move to a better neighborhood, but we kept the first house. We started to Airbnb it. We started making a profit off of that Airbnb. And over the equity that we had grown over a few years, we were able to borrow against that equity, and we turned the garage into a 1-bedroom, 1-bath apartment that now has a long-term renter in it. So this is a property where we have about a $4,000 mortgage that's probably making $8,000 to $10,000 a month in rental income. So this is how you start small. You start at the beginning, build that foundation, and it can segue into larger and larger financial goals. Well, that's about all the time we have for today. Harry, thank you so much for joining us. Everybody, thank you for tuning in to Learning Lending Live. We look forward to having you on a future show. If you're a real estate professional and you'd like to join us, have a great day.